We're probably at the beginning of a major bear market, not a pullback. The stock market is the biggest asset bubble we've seen in terms of U.S. stocks in the history of this country. When this bubble breaks, and we think it's begun to break, we expect a bear market that'll last a couple years, like most bear markets, but it will be devastating in its social ramifications, economic, real-world ramifications, not just to the one percenters, but to everybody. Much like the 2009 thing was, but this is a much bigger bubble. It's scary when you look at the charts.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
This is Elijah K. Johnson with Liberty and Finance. And back with us today, Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Hi, Elijah. Good to be here.
What I wanted to discuss today is, I know last time we had you on, which was late December, you were calling for a major pullback in the stock market first quarter of 2022 and in the bond market. And we've actually started to see that. So what were some of the indicators that you were making you say that we were looking for this pullback? And what is your perspective on where we are right now in both the stock and bond market?
We're probably at the beginning of a major bear market, not a pullback. I suggest to anybody who's can get price charts on their quote screens or on their computers, go look at an S&P 500 monthly bar chart. Go back to 2000, at least go back 20 years, okay? To see the big bull market that peaked in 2000 and the bear market, and which crushed a lot of people, the dot-com bubble. And then go look at the next peak that occurred in 2007, which led to the 2008, 2009 bear market, which devastated a lot of people, not just in the stock market, but in reality. It was a major disruption. Lehman Brothers, remember all that? Okay. And then look at what happened since then. A dozen years of verticality. I mean, it makes those prior bull market bubbles. They call it a dot-com bubble. When you look at that chart, it looks like a little hump. And then in 2007, a little hump. And when you look at what's happened since and understand and appreciate why it's happened, not the excuse of this company did that and that company did that and all these little minor things. The central bank of the U.S. get a chart from the St. Louis Fed on the M2 chart, money supply 2, and Fed funds rate chart, going back, covering that same period of time. And you'll understand why the stock market went vertical, because they printed it higher. They put interest rates effectively at zero for more than a decade. I mean, it went up to 2.5 at one point. But when you compare the Fed funds rate chart going back 40 years, 20 years or whatever, and see where we were at those prior bull market peaks, bubbles, and then see how they responded with their Fed funds rate when those bear markets began. They came in and lowered rates again, of course, and flushed the money system full. This time they've left their foot on the pedal for a dozen years. So we argue that this is a fundamental argument, that the stock market is the biggest asset bubble we've seen in terms of U.S. stocks in the history of this country. When this bubble breaks, and we think it's begun to break, we expect a bear market that'll last a couple years, like most bear markets, but it will be devastating in its social ramifications, economic, real-world ramifications, not just to the one percenters, but to everybody. Much like the 2009 thing was, but this is a much bigger bubble. It's scary when you look at the charts. Now, when we do our momentum work, we don't look at the price charts primarily. We look at, right now we're looking at long-term momentum of the stock S&P 500, the NASDAQ 100, which is where they house most of those high, heavy-weighted stocks like Microsoft, Amazon, Apple, Google, etc. They're extremely heavily weighted stocks, and they're a large factor in why those indexes went up so much, especially the NASDAQ 100. And even those stocks, 4 or 5 stocks of name, constitute like 20% of the S&P 500. And so they explain partly why, when the money went in, it went into the stocks and drove the indexes up. therefore, we're measuring the momentum trend of the S&P, the NASDAQ 100, and three of those symbols, Microsoft, Amazon, and Apple. We figure when those three go, it's over. You don't even have to look at the indexes. We'll argue that if you think you can escape by finding some little area off to the side that's going to survive this, it's not. The whole thing will go. Then we'll go more on a percentage basis. But we've had significant momentum trend breakage. Now, when we plot our momentum charts, we end up with a different picture than what you look at when you see a price chart. Price chart only just began to break. Momentum began to break before price did. And in the process of breaking down, the momentum charts broke structures, meaning the same kind of thing. If you look at a price chart and you draw a trend line, let's say, or you draw a floor on the price chart and you break it, well, that's a structure, okay? We apply those same concepts to momentum measurements. And usually momentum will break trend, change up or down, prior to when price does it. So you get a warning. But the dimensionality of these breakages, we're breaking annual momentum trend structures, not something that goes back 10 weeks, something that goes back, we're talking 10, 15 years of definable trend structures. The NASDAQ 100 last month broke all of our intermediate and then long-term structures, closed the month out below everything we could define as defining a top. Okay. The S&P 500 broke them intra-month, came back in the last 3 hours of trading. We had defined a number. If you close the S&P below 4484 was the number. Okay. It got all the way down to 4,200 and something. Came back in the last few days of the month and closed. And we called that rally, by the way. When the low day, we said it was at 4,300. Then we said, watch out, you're probably going to go back to 4,500. And sure enough, there's been that rally. And it happened to occur at the tail end of the month. So they closed the month out like 0.5% above our breakage defined number for annual momentum of the S&P. So we have a bit of a disagreement there. NASDAQ says, I'm broken. S&P 500 says, not so sure yet. Then when we go to our three big stocks, Amazon is clearly broken. Now, it's having a nice rally right now, but it broke its annual momentum big time at higher levels than we are now. Microsoft and Apple intra-month got below our structural levels, but then popped back above it in the last hours of trading at the end of January, just like the S&P, and marginally closed safe. We still think they're likely to break. And once we get the full defined breakage by including Microsoft and Apple into that negative category, and the S&P closing below its new number for this month, which is, we're below it right now, frankly. So this rally we just had in the stock market, it not only has to hold, it has to gain more ground. Because if it just goes up to where it's gone now and then fiddles around between now and the end of the month, we'll break the numbers we had last month because they adjusted higher this month. Okay, enough of that technical stuff. But if the stock market breaks down, and we've already dropped 10%, our first major swing objective on the downside is a 20% drop off the highs. We've got some reasons for that. It's not because it's the rounded number. We think there's some support around 3,800 on the S&P. Well, where did we drop from? We went from 4,800 down under 4,300, about halfway to that target. And that's where we created this little rally, which makes some sense. Because if you're going to go from Z to A, somewhere halfway in between, you might have a 50% correction, a little corrective rally in the middle of the trend. And most of the time when we analyze various sectors in the NASDAQ 100, our objective on the first drop is about a 20% off the high drop. And at that point, you might get a protracted couple months of holding effort, okay? What investors need to remember is that bear markets in the U.S., with the sole exception of 1929, do not commence with crashes. They commence with arm wrestling. If you go back and examine the 2000 top, the dot-com bubble top, it was arm wrestling for almost a year up there, for the S&P 500 in particular, before it finally then gave up 50% in the S&P and the NASDAQ gave up like 80-something%. But it wasn't instant. There was no crash at the beginning. There was no emotional alarm bell. It was the kind of action that confused people. Because, you get a drop and then somebody says buy it, it's an opportunity, right? And then it rallies. You say, well, see, it's not really a bear market. So they confused you all the way down. That's the way bear markets behave. But even in 29, when you had your first crash, you had a rally 50% of the way back to the high in March of 1930. And then you went into your arduous bear market for 2 years. So what we're expecting here is similar behavior. The problem is that the breakage of this bull market is the breakage of the biggest bubble we've ever seen. And the culprit is the central bank, not just the Fed, but the ECB in Europe and the BOJ in Japan. They created these situations. We've done a better job of doing it because our market's gone up more ballistically than have their markets, for sure. So we're the bubble. Now, the Fed says, okay, we're going to tighten up and correct this inflation problem. Well, go back and look in December where the Bloomberg Commodity Index was. It was trading down in the mid-90s on the index, 95 area. It rallied since then to 110. Okay, so the threat of the Fed to curtail the commodity explosion, which is coming up out of a very deep price hole, an opposite bubble almost, downside, it's coming to life, has not succeeded in stopping commodities. But what's it done is broken the S&P 500 10% off its side, and NASDAQ 100 more than that. It's seriously damaged the muni bond market. There's an ETF called MUB. You can look it up and look at the chart. It's taken out the lows of the last year and a half. And you can go to the corporate debt market, especially the high yield corporate debt. There's a couple ETFs there. And these are instruments, by the way, that the Federal Reserve actually bought, put on their books starting in mid-2020 through the summer of 2021. They were buying these things. JNK is an ETF of high yield corporate debt, and HYG is another one. They've taken out the lows of the last year and a half. So what's gotten intimidated by the Fed's policy shift are not the asset categories they want to intimidate. They're the bubble assets they created themselves. And they've put the pin in the bubble. And our argument is that likely what you're really seeing here is when the Fed turns on the river of liquidity, and when they see the stock market, especially if it gets 20% off the high, and cause sentiment damage, investor sentiment damage, economic analysis metrics will start to shift with the stock market. Stock market usually leads those things into negative territory, not the other way around. Then the Fed's going to have to rethink their policy shift. And already some of those events have started to happen. Like I said, the junk bond market, the muni bond market, these are areas that the Fed does not want to see go down. So all this talk, tough talk about we're going to do this and that, there's realities out there that could put them into a different mode, subtly. And in fact, we dissected Powell's statement that he made at the end of the last meeting, where he had a press conference. He came out with a statement first. We dissected a couple of the paragraphs there where there were some ifs, ands, and buts in there, if you read very carefully. And so our argument is that when the bubble breaks, the Fed is going to have to respond as its sole savior. And the problem is that when they do respond again by trying to support those markets or providing liquidity, or maybe not raising rates as much or at all as they said they would, that the river flow this time is not going to go into the broken bubble. It's going to go into the lesser priced asset categories, and that would be commodities and commodity-related stocks, which are doing quite well, as you know. Oil stocks are doing great. They've been doing great for a year or so. And they're not in sync with the stock market, by the way. You go back and look at the XLE ETF of energy stocks. They don't correlate well with the major direction of the U.S. stock market for the last 5 or 10 years. So they could easily have an uptrend while the stock market goes down. Other areas we recommended over a year ago were fertilizer stocks. They were beat off the page, along with most agricultural-related stocks. They've trended up. They've tripled in price in the last year. They're likely to continue. So from an investor point of view, if you're looking for places to be, focus mostly on commodity-related assets, not necessarily the futures markets, but things related to farming, grain prices, fertilizer is one of them, and focus your attention there as possible places to be long stocks. But the rest of the market is highly vulnerable. And if we're correct on this, and I think we're going to be, we've not missed a major market top in our existence since MSA was founded in 1992. So, and I think this one's in process. And we'll get some more evidence, I think, by the end of this month that, in fact, it is a full court press to the downside. But the beneficiary of that will be that liquidity flow that the Fed will no doubt create. They do it every time one of their bubbles start to break. Will go not where they want it to go. Investors are already preferring, and including some large asset managers of name that aren't gold bugs, but they perceive value, less risk, greater reward in commodity-related stocks because they see historically the commodity prices, though they've had a sharp move up, are nowhere near off the page in terms of historic price levels. Bloomberg right now at 110, for example. Well, heck, it was 180 in 2011. Compare that with the stock market versus 2011. Okay, so that's a place to be looking, and we think the prime beneficiary of this ultimately will be gold and silver, of the commodity price continuation on the upside.
Now, one thing I would like to address is that some analysts are saying that there could be a sell everything moment when the stock market collapses and people are just trying to liquidate everything, at least for the short term. Do you not see that happening? It seems like you're quite bullish on commodities, especially gold and silver.
No, we already have an example. We just dropped 10% in the S&P, pretty sharply too, right? We went from 4,800 to 4,222 in a matter of about 4 weeks. Bloomberg Commodity Index went up. Gold was relatively stable. Silver's dropped maybe a little bit. Most commodities have not dropped. Oil's gained further ground. So what we saw in March of 2020, which is burned in everybody's memory, was a coincident drop in gold miners in the last days of the stock market drop in March of 2000. Actually, stock market started down in February 2020. We put out a major sell. And it was late March. It really caught steam on the downside. Crash dimensions, 35% in a couple of weeks. The tail end of that, the gold miners jumped in for about 4, 5, 6 days. That's all. And then once the stock market hit its low, the gold miners zoomed out of the hole and went from, I think GDX went from the teens, like $16 up to 46 by the summer. A lot better than the stock market. Now it's pulled back, but the correlation of that event, that emotional event, I don't think you're going to get it because I don't think we're going to crash again. I think this is going to be like a typical bull market top where you get double-digit percent drops, but not of the 35% quality in weeks. But instead, you get 10% over a month, and you get a rally, and then you get another 10%, but there's no emotion in it. There's no panic. And that's the way most bull markets peak in the stock market. Without panic. And I think, therefore, people who are afraid of that single event that's burned in their memory of March 2020 need to sort of put that aside. I don't think we're going to see that kind of event again. That's our thought on it.
So it's because of the gradual nature of this crash that the commodities and gold and silver probably won't crash along with the stock market?
Yeah, no, in other words, you get a bear market in the stock market that starts and maybe lasts a couple of years and has huge percentage dimension on the downside, but it doesn't occur in 3 weeks. We don't have a 35% drop in 3 weeks, which we did in 87, which we did in early 29, and we did in March last year. And you'll notice at 87, it didn't begin a bear market. In fact, when the crash was over, market turned up again. And in March of 2020, you had a crash event. It didn't lead to a bear market. Market turned up again. The only time in over 100 years is the Dow in 29 that did crash at the beginning, rallied back 50%, and then went into an arduous bear market. So crashes are not the way bear markets begin. And so I don't think we're going to have another March 2020 in this time. We're going to have arm wrestling with slabs of decline, but not of the emotional variety we had in March of 2020. So I don't think you're going to see that kind of situation where there's a panic to run out of everything. And like I said, we had a very sharp drop in January for the S&P and the NASDAQ of 10, 12% variety, but no consequence in these other markets that you can overlay and show that it went with it. So I think that's the first hint of what we're talking about is arduous bear market in stocks, asset flow into undervalued assets, equity flow into those commodities and commodity-related stocks.
We have some viewers' questions here, and Bob is wanting to know, what are the current momentum trigger levels on gold and silver?
Back in November, we had a level on gold that we would like to see closed above. And it was we were using quarterly momentum. By that, I mean a 3-quarter moving average, which is almost the same as a 200-day. And it had a structure at a couple percent above on momentum where you could see a flat ceiling. Couldn't see it on the gold price chart. It was descending highs on the gold price chart. But on momentum, it was a flat ceiling, a couple percent above that average. So it wasn't at the average itself. When gold popped through there in November, it shot from the low 1800s to the high 1800s. So gold achieved something then that said, I'm awake, I'm awake. You know, that March low of 2021, go by it was 1670. Okay, well, I got up to 1890 in that rally in November last year. The problem was we demanded that silver agree with it, and it didn't. Silver came up, we had a number in the final quarter of last year that if we could close a week out on silver above that certain number, it was in the $25 range, okay? That we said, okay, silver's joining with gold. It's saying, I'm here too. I'm awake. It stopped a penny and a half short of our number on the highest weekly close and went down. So it acknowledged our momentum level as being pivotal, but instead of closing above it, it rolled over from it. And when it rolled over from it, it therefore defined that level a second time as important. And then last month in January, the number had adjusted down for silver to the mid 24s. Okay, and our high weekly close was about a dime below our breakout number for January. So it did the same thing in January. It refused to break out over our quarterly momentum breakout structure. That structure is now so clear that if you could see that oscillator, you would say, oh boy, you break through this, you're going. Okay, but silver it's sort of like what we're seeing in the stock market right now, where we got a negative signal out of NASDAQ 100 and Amazon, but we didn't get the comparable negative signal out of the S&P yet. I think it's inevitable. It'll probably happen this month, but let's forget that. The same thing's been going on with gold and silver. While they've been in a protracted 1.5-year pullback, gold made its low actually in March of 2021, a 20% decline. It took it 9 months to lose 20%. Compare that to the stock market, to lose 10% in 4 weeks. Okay, but anyway, then gold went into a range well above that low. So it sort of stopped its decline, but it's not broken out yet. It's not renewed itself. It said, okay, I'm coming out of this congestion. It did in November, but silver didn't agree with it, and that was very important to us. But in the process of its action, silver set up in November and again in the January rally, that structure is so clear. And it's in the mid-24s. It's applicable for this quarter. If you close a week out above our number, it says silver's ready to go. And the structure is so clear on momentum that when you break through it, we think there will be a rush in silver to get back to the highs we've seen over the last 1.5 years, meaning you'll go from like the 24, 25 zone up to 30 very quickly. I don't know how much resistance will be up there. I don't think much, the upper end of that range, because frankly, most people don't think you're going back up there. So I think most sellers are already sold, if you know what I mean. And if you cross our breakout number for silver, we think it's going to quickly rush back up to the top end of the action of the last 1.5 years and go through that. So our pivotal level is not far above the market, $1.50 or so above the market for silver. And I frankly think you'll see our breakout this quarter. We measure it week by week. We want a weekly close above that number. There's some other lesser indicators on silver that see, right now we've traded over 23 this week and gotten a low under 22. It's a level where silver keeps holding around $22 for the last year, multiple lows there. Pretty soon they're going to need to break it through there and keep it below there if you're a bear. So far, they can't even seem to break it much below there. But if you get back up to mid-23s, we've got some other indicators that say, okay, it's probably going to try to engage that quarterly breakout in the mid-24s. So right now, I'd be watching, like 23.50 area. If you get silver back up there, it's about 40 cents above this week's high. It's probably coming up out of here. Anyway, that's the situation, is that we've had this correction in the precious metal, the monetary metals. Gold has indicated, okay, I've had it. I'm not going to crash through the low again. Okay, that was probably the low in March of 2021. Okay, 1670. But silver hasn't quite agreed yet. So that's what we're watching for. And we think once silver crosses its line, you could probably just throw a dart at the gold and silver mining sector, and that sector will come to life again. And we all know how it behaves. When the gold and silver market are sloppy, they're real weak. When the gold and silver market are in unison on the upside, they get real strong. So it's like an elastic band, very emotional sector. But it's actually started to stabilize recently. The gold mining and silver mining, they popped through some lows recently, and it popped back up again. So anyway, so that's an area we're watching. It hasn't spoken yet, but we're keen on silver. We think it's the one to watch now.
So you're saying it could break above some of those levels this quarter. So it seems like you're pretty bullish on silver. Ron is wanting to know, do you see any downside risk in gold and silver at the moment?
Yeah, we put out an alert. We've done 3 alerts on gold and silver since 2020. In January of 2021 on gold, it was in the upper 1800s and is slipping down from a secondary rally high above 1900. And we said if it hits like 1870, watch out, because the quarterly momentum was breaking down. It hit that, and by March, it had dropped $200. So that alert worked out. And then coming up off the March low, we said that's probably the low. So far, it's been the low. It was 1673. There were 2 times. Last week was one event. We said, okay, we've had enough near-term weakness in gold to imply there could be some near-term downside risk. Not necessarily blow out the March low of 2021, but some downside risk. And also, therefore, some in silver. But this week so far has thumbed its nose at that breakage. In other words, it is a short-term trend analysis now. We're not talking the big stuff. We thought there was enough breakage there to maybe spark some sell-off. And we had a similar alert to that back I forget, it was October of last year sometime, where we thought there might be some breakage, window of vulnerability, call it. And we got the breakage, but it didn't really go very far. And we blew the whistle and said, okay, that alert, invalid. It doesn't look vulnerable. We issued a similar alert last week when gold got down to the 1790s. And right now I think it's traded about 1805, so it's slightly above where that level was. And frankly, if you get gold back up, I'd say about 1820, then our alert is wrong. That near-term alert is wrong. And gold has survived that potential breakage based on short-term stuff and is therefore, comfy. And then again, we'll then shift our focus on the long-term technicals of silver, which is that quarterly structure in the mid-24s. So yes, we saw some vulnerability, but it hasn't materialized yet. And frankly, if it doesn't materialize by next week, I don't think it's going to materialize. Our risk factor for a short-term sell-off is wrong.
Now, I believe we've talked about this in previous episodes, but we would like your perspective on this. If you could remind us, one viewer is wanting to know about the gold-silver ratio and where you see that heading in the long term.
The gold-silver ratio is vastly undervalued right now. Okay, let's go. We've gone back 50 years, back when gold was legalized, 1975. We actually go on back further. But if you compare silver to gold, and we do it on a percent basis, there are 4 times in that 50 years, most of those times coincident with bull markets in silver and gold, where silver reached the 4% level of the value of the price of gold. In other words, it was worth 4% of the price of gold. Right now it's worth about 1.3, by the way. Okay. So it's 4 times in 50 years. It's reached 4%. Actually, one time it reached 6.5%. The other time it reached about 5%. And there have been 2 other peaks just above 4%. So we have 4 times at least got to 4%. So let's forget the 6.5 and the 5. Let's say 4%. It's not a rare number to see. We've seen it 4 times in 50 years. Actually, in 47 years, okay, since 75. Okay, we're at 1.3. Now, when we measure that spread relationship, we plot it like a chart. And we also plot the momentum of that spread, just like we would a price chart. And our assessment is that spread is coming up out of the hole again. Silver performed very well in 2020. When gold shot up from a reaction low in March of 2020, about 1,400, it shot up to 2,000, okay, a little over. Silver at the same time went from a reaction low at about $15 to $30. It doubled. Whereas gold only went up, far less than that. So the gold-silver ratio shot up then to, I think it was nearly 2% or something, 1.5 at least. And since then, while the gold-silver ratio has pulled back a bit, the percent spread chart, it hasn't pulled back sharply, and it looks like it's trying to bottom and go up again. And I think if you get that breakout in silver that we mentioned, the quarterly momentum breakout in the mid-24s, you'll see that spread again reassert itself. We're just simply arguing that historically it's not unusual to see silver at 4% of the value of gold. Well, okay, let's forget about the technicals for now. There have been 3 major bull markets in gold in the last 50 years, not counting the one we're in right now, that had a move of percentage basis, a 7-fold to 8-fold move from the bear market low that preceded the bull to the bull market peak. Each of the 3 bull markets went up 7 to 8-fold versus the low price. Well, our bear market low price in 2015 was 1,046. All we've done is double so far, 2-fold. If gold continues its bull trend, and those bull trends also had congestion zones on the way up. They didn't just go from A to Z. If it continues its bull trend, silver engages again, et cetera, indicating they're coming out of congestion, it wouldn't shock us to see gold do another normal 8-fold. That says $8,000 gold. And fundamentally, it wouldn't shock us at all because of what the central banks are faced with now. They're faced with the biggest crisis they've ever seen, because if their asset categories start down, they only have one choice. And that's monetary and interest rate stimulus to try to protect those asset categories. The beneficiary will be gold and silver. And this is, like I said, it's the biggest stock bubble in the world. If it starts down, it could be one of the biggest or most arduous bear markets we've seen. Therefore, the central bank will go full throttle again. Beneficiary will be primarily gold and silver. This was the case in the late 70s. Same thing with the stock market. It had a big bear market in 74 and then laid waste till 1982. Okay, the money flowed into gold and silver then. But if gold just does a normal, goes to 8,000, and silver goes up to 4% again of that 8,000, you do the math. Well over $200. Okay, so percent-wise, silver has the greater percent for an explosive percent move from current levels. If the major consolidation that we've been in, correction consolidation last year and a half, ends, we get silver to break out over its quarterly. It says, okay, it's over. We're back into bull mode again. That next phase begins, and we think silver will definitely outpace gold by wide margins, such that you could end up with one of those kind of price levels, a gold at 8,000 and silver in the 200s. And it's just back to a place that silver's been 4 times before, at 4% of the price of gold. So we're not crazy. It's not abnormal. It's just echoing past events. That's all.
Definitely will be very interesting to continue to track this with you, Michael. Before we let you go, where can our viewers find you online if they're interested in learning more? And did you have any last thoughts you'd like to leave with our viewers?
Well, our website is Oliver MSA, Momentum Structural Analysis, olivermsa.com. Go to the site. There's some explanation of our methodology, some of our history, some sample reports, et cetera, et cetera. And you can request sample copies of our reports and so forth and explore around the site. There's also a history of our market calls of the S&P 500 from the early 1990s through, I think it was through about 2016, calling tops and bottoms and so forth. You get to see the old reports. Another event that's going on right now, though it's not directly correlated to movement in gold short term, and that's dollar. We think the dollar's topped of this secondary rally we've had for the last year or so. It's gone from under 90 up to 97 on the dollar index, which is not a big deal on percent-wise. In fact, the dollar's been one of its most narrow price ranges since 2015, so going into our 7th year now, of about a 10 to 12% range, which if you go back 50 years, it's hard to find a range that quiet. So foreign exchange has really not been a factor in moving assets. But the dollar, in our view, just topped above 97 and is in trouble. If you ever get back down around 90 again, I think the bottom comes totally out of the dollar. We go down into the 70s, which is where the last major low was. Obviously, if you're a foreign investor, and they're one of the biggest investors in history in the U.S. stock market over the last few years, foreign investors have been a huge factor. Well, they're impacted by negative movement in the dollar. They're not just looking at the S&P, they're measuring it in dollars because they bought it in dollars. So if the dollar turns, that would also be negative for the stock market. And though gold didn't need a bear on the dollar since 2015, because in 2015, if you go back to December of 2015, when gold made its low, the dollar index was at 97. That's where it was 2 weeks ago. And yet gold doubled in price. So you get the point. But still, I think if the dollar does turn down now, and we think it's turning down, that will be a wave effect at the back of gold, help reinforce it.
That perfectly makes sense, that if the dollar falls, it will reinforce gold there. And it'll be, again, very interesting to see how this year plays out. And even the first quarter, it looks like we might be seeing some fireworks there. So
I think so. Yeah.
Michael, thank you once again for joining us today, and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.